Good Friday afternoon to you. Welcome to the John Sanchez Show on Newstalk 780 KOH. It's a pleasure to be with you. A pleasure to be with my partner, Jason Gaunt, TGIF, my friend.
Yeah, definitely TGIF. It's been a crazy week. I would have expected a little more volatility than we had, given all the
more
data.
You don't think you didn't get your fill?
Well, I mean, the end of the week, what were we? S&P was up like 20 basis points or something.
Yeah.
It was sort of nothing happened.
Yeah, but boy,
We did
intraday
well,
was
but
though.
nothing really happened.
I definitely produced a few more gray hairs this week. I'll tell you that. Definitely a few more gray hairs. Now it was a crazy week, and we're going to get into this, folks. First of all, welcome to all of you. Thank you for joining us. We've titled today's show "Optimism versus Pessimism on Wall Street," and who's going to be right? I mean, that's really the big issue that we're dealing with, because exactly to Jason's point, I'll just jump right into it. This was really a tug of war between the Bulls and the Bears this week, right? You had, and again, not so much where it was all said and done at 1 o'clock, which is really all that matters, but intraday, you had some significant volatility. Seems like, if memory serves me correctly, almost every single day this week, Jason. And yesterday, I've been dying to, because obviously you weren't on the show yesterday. Yesterday was a bizarre day. And I was hearing the little Jason Gaunt voice in my mind yesterday throughout the day, and I'll tell you why. It was a day where we saw there was not a lot of news, first of all, but it was a day where this market just didn't budge. I mean, we finished down, was I think 32 or something yesterday, but there were times where this market was just barely budging. I mean, numerous times when I did the stock updates in the morning, it was just, like the S&P basically unchanged. And so I went, oh my goodness, it almost feels like we were getting back into that position that we were, what was it, like a month or two ago, where it was like NASDAQ did fine, S&P did fine, but the Dow was just like it couldn't go anywhere. It's like it was almost like an even 15 up, 15 down type of thing. So I think the reason I'm bringing all this up, I think my takeaway of this week was it was definitely a tug of war. We say that a lot on this show, but this was a week that was depicted by a good tug of war between the Bulls and the Bears. Thank goodness we ended out today okay. I mean, we were a lot better earlier, but overall decent. And I think that's, again, why we have so many things to talk about, which again, what are the things the market is, or I should say investors are optimistic about, and what are the things investors are pessimistic about at this point?
And I think the Bulls and the Bears both have lots of valid reasons to have their views. If we looked at the bull side of the market, I think they're in command right now merely because of you've got an interest rate backdrop that's favorable. The adage of don't fight the Fed couldn't be any truer right now. And I would argue you have that backdrop until May at the very least, because whoever Trump puts in place is going to be a dove by all accounts, merely because that's how they're going to get their butts in the seat. And so I think that's the part that the market very much is keen to. Most likely we get a rate cut here next week, and
next Wednesday.
Maybe they skip one or two to see how the data is. But PCE data today was, I would say, nothing that would make anyone freak out from the sense of, oh my gosh, if you cut rates, you're going to send inflation through the roof. And even though we got a really good jobs number earlier in the week, it seems that the market's not as scared about that. So your bull backdrop is lower rates, favorable economic backdrop merely from Trump, as most would view him as. He's business friendly. So you saw the likes of Netflix with Warner Brothers, a $70+ billion deal. That's probably not something that happens.
I'm so glad that's over.
Yeah. I mean, it's going to go on for a while.
Everybody gets so excited about it.
Antitrust.
Really?
Yeah. I mean, media stinks.
All day long.
I don't know why. I don't know why Netflix wants to buy this business.
I don't either.
But, so that's what the Bulls have. The Bears, we dealt with what they were focused on about a week and a half ago with AI and valuation and circular reference errors around ordering and, China, NVIDIA, US, who ultimately is going to win that whole battle. So there's a lot of reasons to be a bear as well. You can't have 4 up high, double-digit return S&P years. So, odds are you got to think next year is going to not be as good as the last 3 were. But who knows, right? So I think it is a tug of war, and that's what we're seeing right now. And I mean, technically, market still looks well. You got a lot of support, both at a rising 50-day, 200-day. So there's lots of levels below that you'll see buyers unless there's some geopolitical shock of some kind. So it's a fun market. I like seeing the green into year end. And finally, you've got the backdrop of just Santa Claus, which tends to be favorable this time of year too.
Absolutely. Well, speaking of the year, it is once again shaping up to be a decent year. By all means, not even decent, but an excellent year. If we can hold these going into these final few weeks of the year, for the year, the Nasdaq's up 22.1%, S&P's up 16.8, Russell 2000 up 13.1, and the Dow up 12.7. So, Jason, I like. That Russell 2000 snuck up on me. I hadn't been watching it real closely, and then I was looking at the numbers, getting ready for the show. I'm like, my goodness, already up 13.1%. That's a very bullish sign there.
Yeah, it really is. And I mean, there's also, hold on one sec. Let me see my end of day performance report I sent you. The emerging markets up 30.1, almost 31% this year. And Europe, Asia, Far East up 27%, right?
Even better than us.
Right. It's been a all hands on deck rally globally because of, you've got lots of folks looking to stimulate European markets, looking to use some debt to fix their problems. The chart still looks good looking at IFA and Japan.
Mm-hmm.
Clearly has their interest rates to focus on, but it's a pretty bullish backdrop overall.
Absolutely. And we're going to go through the bulls and the bears with their, again, Jason kind of went over the list briefly, but we're going to go into details of the bulls versus the bears. And again, the optimism versus pessimism. First, let me kind of tell you what some of these moves were today. So let's go back to the PCE data for a minute, Jason, because that was a really important report. And like I said, it was a decent report overall. But I want to kind of highlight a little bit of concern that I have, and I know you do also, when you break down this report. Because if you look at, and remember, folks, if you're not familiar with PCE, the personal consumption expenditure, this is the Fed's favorite measure of inflation. They look at it closer than they do CPI and PPI, the traditional measures that most of us look at, because it comprises a lot more data points in different parts of the economy than CPI or PPI does. But you have to, first of all, when they release the PCE, they before they come out with that number, just a few seconds before, they release personal income and personal spending. So let's kind of start with that one for a second. Personal income and here's the problem though. This is September's data, so keep that in mind. We're still getting caught up from the government shutdown. But if you look at personal income, it was up 0.4%. Again, this is September. If you go back to August, it was up 0.4%. But what I like about it is it beat the personal savings side of things, which is the other report. It did beat that. The personal spending side was just slightly higher on that. It was up, personal spending was up 0.3, personal income up 0.4. So, 0.4% on the income side, spending up 0.3% is what I was trying to say. So we didn't spend everything that we made, I guess is the way to look at it, which you and I both know, Jason. We've seen many, many reports over our career where it was reversed, where the spending side exceeds the income side. So that was one takeaway that I thought was a bit positive. But here's the negative. Let's get to the PCE side of things in a little bit more detail. So once again, if you look at the PCE side of things, it was up 0.3% month over month. Again, this is September's data, so keep that in mind, up 0.3% month over month. Strip out food and energy, get down to the core, it was up 0.2%. But here's what I didn't like about it. Up 2.8% year over year.
Better than August.
Huh?
This is better than August. I guess August was 2.9.
Exactly. But that's 0.8% away from the Fed's mandate of 2%. Explain why that's important.
Well, it's important from the concern around inflation, but if we want to be a bull, it's a step function of we got a lot of growth going on in the economy. You've got forever we couldn't get above 2%, and now we're horrified, scared of being at 2.8, right? And not to discount what you're saying, but that tends to go hand in hand with a economy that's firing on all cylinders. And we're not at 6. We're at, it's above target, but not something I'm too worried about. And if it's from 2.9 to 2.8, hopefully we're getting a bit of deceleration. A slowdown in jobs could help, but we didn't really get that this week, right? I mean, with the ADP number, and jobless claims number was 54 years or something. Again, who trusts the data? But
Kristen Snow, right now, Traffic Center. Kristen. Back to the John Sanchez Show on Newstalk 780 KOH with Jason Gaunt. All right, here's how we finished up, and happy Friday, by the way. 104 gain on the Dow, 0.22%. Our closing level was 47,954. NASDAQ rose 73.31%, closing at 23,578, and up 13 on the S&P 500. Finished the day at 6,870. Again, on the commodity front, we had oil prices rising 39 cents to $60.07 a barrel. So still a very comfortable level, feeling good at the pump these days. 10-cent losses all on gold, 4,243.50. 3 basis point increase on the 10-year treasury. 414 was our closing yield, but for the week, up 12 basis points. Isn't it interesting, Jason? Let's go back to the Fed as our first point as we discuss, again, optimism versus pessimism. So we have a Fed interest rate decision next week, Wednesday, as we said. We'll get the decision at 11 a.m. and then the press conference with Jerome Powell at 11:30. Odds are still north of 80%, high 80s, low 90s, depending upon what time of the day you look at it, that we're going to get a 0.25% cut. Again, back to my concern in regards to the PCE number coming in, again, 2.8%, up 2.8% year over year. Fed wants 2%. So we have that. And then the bond market's telling us something different. Again, edging up, like I said, 12 basis points for the week. There's going to be a lot of arguments out there next week. If we do get the 0.25% cut, which I hope we do, there's going to be a lot of arguments. People going, wait a minute here. What are you doing, Jerome? What are you doing? It's the data is not supporting an interest rate cut. Matter of fact, you should have either gone unchanged or maybe even raised rates 0.25%. That's going to be one of the arguments out there.
he's damned if he does, damned if he didn't, I guess.
He probably doesn't care anymore.
The shorter end of the curve has been much more behaved. It's just a little bit of curve steepening that is very much to your point that the market's longer term worried about inflation, that this could be a short-term phenomenon. Trump pushing his thumb on the scale for the next 6 to 12 months, but inflation is still the thing that the market's more worried about than the need for stimulus. You've got the 2-year still sitting at 356. It was up, I don't know, 5 basis points this week, but the 10-year steepened more. That is healthy. You want an upward sloping term structure. As much as we've been used to this inverted yield curve, the normal 2s10 spread is positive. And as it gets more positive, it just infers that the market is pricing in more growth or pricing in inflation pressures of some kind. We're not at some weird, crazy, steep level that seems like it's freaked out about inflation, but says near-term rates are going lower, but longer-term rates are going higher. And that's a lot of what we're seeing. That's the tell.
It's a Friday, so let's have a little fun with this, okay? So one of the big events, of course, of this week, I forget which, I think it was Wednesday, the market got really excited when Kevin Hassett was in the White House and the word started to kind of spread that, presidents, first of all, the week started with the president was going to have a decision who he's going to pick as the next Fed chairman by Christmas. And then towards the end of the week, it was like, no, the first part of the year. Many on Wall Street feel that Kevin Hassett is going to be the one that the president selects. Wall Street loves this guy. If you just go down the path and say, if he is the one that the president chooses, we could be in for, and again, assuming he has good influence on the rest of the voting members of the Fed, we could be in a very aggressive interest rate cut cycle in 2026, 2027. And of course, that could spur phenomenal economic activity, which is, again, why the president most likely will nominate him. At least that's the betting case right now, which would be obviously significant for the stock market in a positive sense and significant for the real estate market in a positive sense.
Yeah, no, it could be the case, right? But who knows come midterms too, not that midterms are going to change what he would be doing, but that's just another data point on the horizon that could bound up Congress, which we know the market tends to like when nobody does anything stupid for 2 years. But yeah, I mean, that's what it said. Is it near term? It's showing that rates are going lower. They probably have another 75 basis points in total that they could cut and still claim neutrality. And any more than that, you're starting to stimulate, which time will tell whether that's the right call, inflation wise or otherwise.
Yep. Okay. All right. So let's continue on our theme. What are the bulls excited about? So we said inflation's cooling, the Fed shifting towards rate cuts, earnings remain strong is our next one. Good data. I mean, we're just very much winding down the third quarter earnings season, but overall it's been good so far. Jason, what I find amazing, I brought this up the last couple of weeks. What I find amazing is a lot of younger companies seem to be dominating the headlines, predominantly in the AI or the tech space. Names that really aren't household names, but are just coming out with amazing earnings numbers. And the result is, of course, we're seeing significant movement in the stock of many of these companies. Again, a lot of names that when I go through them in the morning on the stock updates, I'm like, I've never heard of this company, but stock's up $25 or something. It's crazy to see how widespread these earnings numbers are coming in. So if we take our Fortune 500 household names, they've been doing well, but then now we're adding in this layer of kind of no names, and they're also doing well. So a very, very wonderful earnings season and environment that we find ourselves in.
And that's why you mentioned the Russell earlier. You're
Mm-hmm.
seeing that broadening out, the benefit of lower rates and the thought that rates could be even lower. There's companies that are non-household names that are AI adjacent, right? They're
Yes.
tech companies. They're benefiting from the efficiencies offered by these new technologies, and we're seeing it. Whereas some areas are not doing as well. But I mean, look at banks, look at Goldman, look at some of these things. They've been parabolic,
Yes.
clearly
Caterpillar.
highlighting that the market's not too worried near term around overall corporate growth
No,
or
not one bit.
financial stability.
Yep, not one bit. All right, we're going to finish up our bull case. Two more points. We touch on this briefly. Let's go to our fourth point, which is AI megatrend. It is accelerating. This was another one of those weeks, Jason, where we had, I would say, kind of a mixed showing of AI related names. We don't have time to go through all of them, but Nvidia was relatively flat for the week. I think if I kind of go back where we started, where we finished at, it had some up days, some down days this week. But there's an interesting article, and I wish I would have kept it. I think it was on CNBC yesterday, saying cash is the problem. I think the title of the article was "Cash is the Problem at Nvidia." They've got too much of it. I mean, what was it? 280, $300 billion in cash. And it's just, obviously, it's a cash producing machine at that organization that they can't spend the cash fast enough. And so you look at the AI trend, there wasn't really a lot of negative news this week, like, oh my goodness, we're in an AI bubble, that type of thing. That seemed to calm down. I think that was one thing that helped out a lot of the AI related names this week.
And that's what spawned the whole circular accounting and them funding that. Like, they have, what are they going to do with it, right? I
That's
mean,
right. That's
buy a
right.
baseball field, right? They're not a producer. They send them to the likes of Taiwan Semi to
Mm-hmm.
produce. And even if they were going to spin up their own fabs, it would take 3 to 5 years to get them operational. So
Yes.
yeah, they're just a cash cow, and they're spending it on new technology, probably spending it on new people and new bots to replace said people.
Absolutely. Absolutely. Our final bull case is consumer wealth that remains high, right? Many of you are doing very well in the stock market this year based upon those numbers I mentioned earlier. If you're not, please give us a call. But your 401k should be doing well, et cetera. So indicative. Now, we did get the preliminary review from the University of Michigan today. This number was not great. Reading came in, and again, it's a preliminary reading came in. This is December's data. Reading came in at 53.7, which again, historically is not a great number. But what I didn't like about this, and again, this is a survey of consumers, again, by the University of Michigan. What I didn't like about the number, Jason, I went back, and a year ago that reading was over 100. So the consumer is still feeling, a little bit nervous about everything, which, again, they have a right to. There's a lot of people losing their jobs. And back to what I said before we went to break, yeah, the Challenger Gray Christmas layoff report, and there are now over 1.1 million layoffs have occurred so far in 2025. And this is equivalent to going all the way back to the year of 2020, i.e. the pandemic era. So that's what's got a lot of economists kind of scratching their head going, man, we're not seeing it in the initial claims, the continuing claims. We're not even seeing it in the unemployment report. Man, we're at almost historical levels of layoffs. And I was bringing this up to Corey and Dwight yesterday, and what I said, and I'd love to get your opinion on it, is I think the reason we're not seeing it in the aforementioned reports is simply because a lot of these people are getting severance packages, right? If they're getting laid off in tech, which we know that's been a large portion of the layoff numbers, they're getting some hefty severance reports or severance packages. And so therefore they probably are not able to collect unemployment because they're still on quote payroll, even though they've been laid off. So this may be a lag effect that we see in, I don't know, 3 or 4 months. I don't know what the normal severance package is in the tech industry, but could be even longer than that. But I think that's why we're not seeing the numbers correlate.
Yeah, I mean, it's lots of reasons. I think your spot that definitely makes a ton of sense where people can't collect, and as we thought, the thought is companies are going to hold back on hiring as well because
Mm-hmm.
not that they're firing people yet,
That's right.
but they don't know what efficiencies they can find from technology, so they're probably waiting and noodling around to see, hey, how can we use this before hiring those new
Absolutely.
people?
Yep, absolutely. All right, so there's the bull case. Now, what's the bear case? What are investors worried about? We'll tell you about that when we come back. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hello, Jack. Welcome back to the John Sanchez Show on News Talk 780 KOH. Happy Friday to all of you. Of course, joined by Jason Gaunt. 104 gain on the Dow. NASDAQ rose 73. The S&P higher by 13. And we're kind of making a bull and bear case here for you this Friday. Give you some things to think about next week as we go into the Fed interest rate decision week, and a lot of concern again. There's still, even though the odds again are very favorable that we're going to get our 0.25% cut on Wednesday, the odds are there's still many on the street saying, once again, maybe the Fed shouldn't do anything next week. Now, Jason, the last point I want to mention, then we'll get to the bear case. And what I find very ironic, and I wish I would have had the time to get the audio clip from when Jerome Powell, had the last interest rate meeting. And remember, he really kind of, excuse my language, but pissed off the street by saying, bottom line, don't expect another rate cut come December. And you and I joked that day on the show saying, well, what do you think he's going to say? He's not going to come out and say, hey, we got one more coming. But
Yeah.
it'd be very ironic if he does not cut rates, which the street would be very upset about, going back to what he said a few weeks ago.
Or he just grenade diet and just
Mhm.
drops rates 75 basis points and
Oh
just
my
like,
goodness, can you
boom,
imagine?
there you go.
Can you imagine?
I'm
Yeah.
out.
See ya. Yeah, I'm out. I'm
Jerry
out.
out. Jay
Later.
Powell done. Yeah.
Yeah, Jay Powell out. Sidesteps to the side.
Right.
I'm not coming back anymore. You guys can
Slams
figure
his
this out.
mic on the
What are you going to
ground.
do? Fire me?
Right,
Yeah,
exactly.
All right, let's go to the bear case. What are investors worried about? How about geopolitical tensions? We haven't had to talk, thank goodness, in much detail recently in regards to the international scene, but it's still lurking out there, right? We still have Middle East, we still have Russia, Ukraine, South China Sea, a lot of different things that are going on. Luckily, again, none of those are at the top of the worry list at this point.
But they can be.
Boy,
They're
can they?
simmering, for lack of a better term. China, I mean, the fact that Xi and Trump are whatever they're doing, dancing, talking ish, sort of.
Mm-hmm.
I'd say that's a positive. I think that keeps the overall concern down. Putin made comments about attacking Europe pretty recently, and that people said, yeah, whatever.
All right.
Yeah, the geopolitical is always the unknown that we worry about as investors, right? That's the thing that can come out of nowhere and shock whatever diversified portfolio you think you have put together. Correlation goes to 1, and so yeah, that it always tends to be the thing we worry about.
Absolutely. All right, let's go to the second worry point, which is a recession or a slowdown risk, right? Even though we're saying, hey, economic data has been good, corporate earnings have been good, there's still another camp out there that says, well, wait a minute here. Let's go back to what we were saying before we went to break. Let's talk about the labor market, right? Even though the initial claims are showing okay, continuing claims are showing okay, unemployment still showing okay. Again, as I mentioned, you have mass layoffs that are going on, and that for all likelihood should probably continue for a while. I've said it before, folks. You better get used to us telling you that there's 8 to 10% unemployment rate, because I think that's where we're going to be in a couple of years. I really do. But we are seeing a weakening consumer, indicative, as I said, by the preliminary University of Michigan number. But let's break it down to real sense. People are defaulting on their car payments. People are starting to default on mortgages. Credit card delinquencies are rising. The consumer is stretched so thin, meaning many of you out there, you're stretched like Gumby, right? You just don't know where to go. You're concerned about your jobs. I was, me, Jason, I never pay attention to social media, but I got a LinkedIn invitation today, and I never click on those, but this guy's, I guess you call it, profile was kind of interesting. So I click on it, and all of a sudden, of course, it brings up and shows all the common people and everything. And so I clicked on a longtime friend of mine, and I started looking at her profile and her conversations, and I was shocked. And this is a friend that used to be involved in our firm, so I think you know who I may be talking about, who no longer is with us. But I was shocked to find out her friends how many were laid off. I mean, it was like one, and she's in the tech industry, one after the other. Well, just got my layoff notice. Oh, I'm so sorry. And then here comes another person. So that to me was real life, right? Seeing that real people, and these were just in the last couple of weeks, losing their job. I mean, we read about it, talk about it a lot, but when you actually see it and you can feel the fear and the frustration in the people's voices, that's reality. And there's a lot of that going on top of, imagine getting laid off when you are already being stretched, due to, high car payments, high mortgage rates, etc.
And those people tend to have higher incomes, and they have
Yes, they
more
do.
expensive things that when they can't make their month-to-month
Yes,
costs.
that's a good point.
Remember, living in the Bay Area, et cetera, even if you have a high-paying job, you have a high-cost life that, relative, it probably feels like you're, making normal income with normal cost life. It's just those things are incredibly expensive. But remember, tech's always going to be the fastest to react. They're the quickest to adopt AI. They're the quickest to digest it and realize redundancies and efficiencies. And we don't need this person, or we can hire one instead of two, because they always are doing their 10% riffs just as a function of their, their technology people. Why keep around in the laggers when you can go hire, another 10% of cheaper, quicker, faster? But it's the rest of the economy that I worry about, and like we've talked about a bunch, I don't get worried until the end of 26 or 27 when you've got a lot of corporate debt that needs to be financed. But companies that are waiting to hire because they don't yet know how to use the efficiencies around AI, they're the ones who are going to either lay off or just not hire as they try to figure out, wait, I can do this without hiring two more people, or in fact, I don't need this high cost person. So that's where it gets a little uglier, to your point of 7-8%
Yes.
unemployment, whether
Well,
temporary or long
like
term.
like like today, there was a story on the Wall Street Journal. I didn't get a chance to read the whole thing. I was kind of glancing through it, regarding Amazon. They've just come up with a really powerful, I'll say, group of agents, right? AI agents, and they're now selling those agents to other companies, and these other companies are seeing 40 to 60% efficiency improvement. As you and I, and even Dennis, when he's on Mondays, as we try to look into our crystal ball and say, okay, where's all this going? How are these companies going to make money? It's going to be a situation like that, right? He who comes up with the best AI bot or AI agent that can say, okay, this agent's going to take the place of whatever, 5 human beings, 10 human beings. That's when we're really going to start to see the layoffs accelerate, is when a company like an Amazon or whomever that has the clout to go, hey, we'll sell. I can see it, Jason. I mean, I let my mind kind of wander on this thing. I can see it almost like a professional draft, right? It's like, hey, I'll pay you, whatever, $10 million for your agent, Amazon. Oh, but Nvidia, I'll pay you 11 million. Yours is a little bit better. You know what I'm saying? They start
Yeah.
bidding on this. I mean, because look at the massive savings. So it's going to be interesting to see what happens on that side of things. All right, we come back, just a couple more points on what investors are worried about. We're going to talk about market valuations and a few other things as we wrap it up. Let's turn it over to Kristen Snow right now, Traffic Center. Hello, Kristen. Welcome back to the John Sanchez Show on News Talk 780 KOH. All right, we've been talking about the bulls versus the bears, what people are optimistic about, what people are pessimistic about. Let's go to another one, Jason, our fourth point, frothy valuations.
That's the biggest, I'd say, arrow that the bears have in their quiver, right? Most numbers you look at will say that this market is very stretched from a valuation standpoint, despite earnings being as good as they've been. They've also been good for a long time, which means at some point trees don't grow to the sky, right? The S&P valuation, the concentration of where the valuation is with the Mag 7. It's been nice that we've seen some other areas do well and take away all of the heavy lifting that those big 7 stocks have done. But historically, buying the market at this type of evaluation tends to have pretty muted forward returns, right? Like anything, doesn't mean that it's going to go down. It just means that the probability of it going up a lot is low, right? It's like buying an expensive house. It can stay expensive for a long time and even go higher like they tend to over time, but you tend to do better from an investing standpoint when you're buying a house really cheap. And so that's the part that the bears very much can stand around, because historically, when we're at these levels, especially coupled with the economic environment being as well as it is, and interest rates maybe coming down a bit over the next 6 to 12 months, but don't have a big way to go from there, you may run out of the juice that's keeping things going. And that's the part that's
Let's tie that into the volatility index. Here we said I'm looking at 15.41, right, on the VIX.
Average.
Yeah, let's tie that into frothy valuations.
Yeah, I mean, we saw the VIX get up into the mid 20s
Mm-hmm.
a couple of weeks ago, but that's a buying opportunity. Historically, you buy when it's at 24 and you sell when it's at 12. We're in the middle. The market's kind of calm, expecting not a lot over the next 30 days. Remember, that's what the VIX is. All it is looking out is 30 days. So we got Christmas, we got New Year's, we got not a lot of big data points coming up in the next 30 days. And probably once you get the rate cut, there's even less volatility expected. So that's really all it's telling you now. But once we get closer to the end of the year, watch VIX, merely because of the January effect as to, are we going to get big buying, or have we already got the big buying over the last month or so? You'll get the beginning of the year, people trading around to start a new game plan. So I expect that to be exciting.
Excellent. Oh, yeah, no doubt about that. Hey, two things, folks, that I wanted to mention that we notified our clients about, and we want to share this with you. First one is just a quick reminder as we wrap up the year, your flexible spending account, your FSAs, if you have one of those at work, that money needs to be spent by the end of the year. You're going to lose it. So make sure you take a look at your account and talk to your HR, et cetera, and try to get that money spent on the eligible items. The other thing I wanted to mention, and we'll probably do a show on this here in a few weeks, but again, we already notified our clients on this one, is remember, starting next year, if you make more than $150,000 a year and you you do a catch up in your 401k, it's no longer going to be pre-tax. It has to be an after-tax Roth contribution. So those of you in high income brackets and you count on doing that catch up and you like it doing it pre-tax, can't do that anymore. Make sure you talk to your financial advisor and or your accountant and see if that's going to have any tax impact on you going forward in 2026. Again, it's going to be effective in 2026. Mr. Gaunt, have a phenomenal weekend, my friend.
You too. You too.
Thank you. I appreciate it. All right. God bless everybody. We'll see you on Monday on the Jon Sanchez Show. Have a great weekend. See ya.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.